Hi everyone, and welcome to my latest trading tutorial on Market Mum's Strangle strategy. This is the newest in my series of stress-free strategies for today's market, which we all would like, I'm sure. The market can bring out the worst in us, but I'm aiming to bring out the best, so let's get on to it. Now, what exactly is it? Basically, it's a non-directional strategy that takes advantage of strong market moves in either direction. And volatility plays a key. It plays a vital key, in actual fact. But this being a non-directional strategy, I mean, we don't care whether the market goes up or down. We just want it to move in one direction. And, I mean, has the market ever stood still? No. So it's very, very rare that if you don't make money trading this strategy, and if you do, then if you don't make money, well, it's because you've made a mistake with this volatility here, and I'll go into that as the tutorial goes on. Okay, so why do I do it? Well, there's only one reason, and that is to produce a regular monthly income. Now, you don't, always, make the income every single month, because, with rollouts and things like that, you might might be over 2 months, but you might make a bigger sort of profit, and then you just, average it. If you average it out over the couple of months or whatever it is that you're in the trade, that still works out to me as regular monthly income, and it's certainly given me some nice income for the last couple of months I've been doing it. So I'm sure you're all asking, how does it work? Let's go into it. So basically, we've got 3 simple steps. The first one is identify a stock. And before I get onto it, I just want to say you've got to keep your strategy simple. Now, there's a lot of hype out there saying that if a lot of people think that if you want to be successful, and something has to be, something's profitable, it has to be hard. That's a load of rubbish as far as I'm concerned. The only way to be successful is to keep it simple. I mean, my philosophy on life is simple. You get back what you give out, and that's my philosophy. So I always try to give the best, and therefore I get the best. So anyway, enough on the philosophy. Let's get back to the strategy. So yeah, 3 simple steps. First, I identify a stock. I then buy a call option, 1 strike above the current stock price. And at the same time, I buy a put option 1 strike below the current stock price. Now, when I say I identify a stock, I mean I've done some technical analysis to, decide which stock is trading in a pattern that's looking, might be having a breakout or stuff like that. Or I can see the Bollinger Bands coming together, and the stock volatility is quite low. So I'll get into exactly how to identify it on a chart shortly. But at the moment, these are the basic steps that I go through, and all these things are done at the same time, or the buying of the call and the buying of the put. It's all done at the same time as a spread trade. So you have to remember that it's all. You don't just buy a call and then say I want to buy a put. It has to be done at the same time to get a proper spread price. Now, why do I like it so much? Well, there's lots of reasons, but this is the main one. I don't know whether you know, but I've recently wrote a book, Mastering a Winning Trader's Mindset, all about your emotions of fear and greed, and how the market sort of can control your mind, I suppose, and instead of you controlling your mind. Now, I go through lots of exercises in there to help you take back the balance of power and look after your own mindset. But the main emotions that are in trading is fear and greed, and this book actually goes into how to master and how to take back your control of those emotions, and use a system basically when you're trading, so you eliminate the pool of fear and greed. And so this strategy actually eliminates all those emotions, really, because you're hedging yourself both ways. So I'll get into more about it. Buying a put option and a call option eliminates your fear emotion. It eliminates that fear of, have I picked the right direction? Oh my God, what if it goes down and I bought a call, or what if it goes up and I bought a put? Totally eliminates it because you've hedged both ways. You can do no wrong. It's there. You've covered yourself both ways. So that's a big one. Instantly eliminates that fear emotion. Now, being able to adjust the strategy, I believe, eliminates your greed emotion, because you might be hesitant if the strategy's going really well and you're in profit, and you might be hesitant to close it out because you think, I might be able to just squeeze out a little bit more. But the way I roll out this strategy is that I take my profit off the table, but I also place another strangle at the price, at the stage, or at the price where I've taken my profit. And usually I can do this with a credit to my account, even after I've closed out one side. So you don't need to be, if you've got profit there, take it, and then just make another, trade another strangle, put one in place immediately. So you're always in the market, you're always going to be able to take advantage of whatever happens. So that right there eliminates that emotion, which I love. And having a non-directional trade is hedging. So you've got your sleep at night factor there. You're not, stressing over, oh my God, what if the market, what if the US plummets 200 points? What am I going to do? Or what if it rises 200 points? So you've always you're in there. You've got it hedged either way, and you can basically make money whatever happens. And what's great about it is the stock can move up and down during the month, and you profit both ways. So it can have this huge move up. You grab your profit, put on another strangle, and it comes all the way back down again. And you've profit coming back down, but you profit both ways, like you profit doubly coming back down because you've bought another strangle with another put, and you've already still got the other one in place. So love it, and I'll go into that a bit more shortly. Now this is a payoff diagram. We'll look at the bought strangle at a glance, because a payoff diagram is good to be able to see, I suppose, like I say, a picture says 1,000 words. To be able to read a payoff diagram is important, because you need, at a glance, you can see this is usually your zero line, and you have your stock price, like where you've bought the strangle here at the stock price, and it shows you each way when you start to come into profit. These are your break-evens here, and your break-evens here. I mean, normally this would be probably a bit closer together. You've got break-evens here and here, and anything after that is a profit on the put or a profit on the call. And this is your limited loss. This is your limited risk. As you can see, this is profit, and down here is loss. So, and even if it does start to lose money, the market doesn't move the way you want it to, or the market actually goes sideways for the whole month, we can adjust this strategy, and we'll never make a maximum loss. It just doesn't happen. So, like I said, the strategy at a glance: you buy a call and a put at different strike prices, not at the same. Don't confuse this strategy with a straddle, which is buying a call and a put at the same strike price at the money. This is different. Basically, we buy an out-of-the-money call, which is above the strike price, and you buy an out-of-the-money put, which is under the under the stock price. So you buy an out-of-the-money call, which is above the current price of the stock, and you buy an out-of-the-money put, which is below the current price of the stock. Okay, and it has a limited risk and an unlimited profit potential. Who doesn't like the sound of unlimited profit potential? That is fantastic. And limited risk. You can never lose more than you put in. Whatever the cost of the strangle is, that's it. You can't lose more than that. How do we like that? I think we do.